Couple of more growth and income opportunities to tell you about now, and that's what our growth and income strategist, Todd Bunton, is going to do. He's got a couple of ideas here that you want everyone to know about, right?
Yeah, shout him from the mountaintop.
Well, at least from the old video ranch.
Right.
Avalon Bay Communities, a REIT that's been around for a while, is one that you've identified.
Yeah, that's right. They're actually an apartment REIT, and I'm really bullish on the apartment REIT space. If you think about it, homeownership rates have been declining since the housing bust, and originally people were moving into mom's basement, but now that there's starting to be more jobs out there, they're starting to move into apartments. You're seeing homeownership rates decline, but you're seeing occupancy rates at apartments increase, and that's certainly the case at Avalon Bay. Not only are you seeing occupancy rates increase, you're seeing rental rates increase too. Now, this company owns or has an ownership interest in over 53,000 apartment units in 9 states and the District of Columbia, and really high rental areas already. It's New York, obviously DC, like I said, New England, Northern California, the Pacific Northwest, and Southern California. A lot of their places, the average rents are over $2,000 a month already, but that rental rate is increasing. That was on display last quarter. They delivered a very solid third quarter beat. Occupancy rates were solid. Average rents were up 4 or 5%. So very solid growth story here. And analysts have definitely been bullish on the stock. It's a Zacks number 2 ranked stock as they've been increasing estimates. And they project their funds from operation, which is basically a REIT's income. They expect that to grow at a double-digit pace over the next couple of years. So there's a lot to like here, obviously with the growth story, but I would say, as a REIT, it's a good income story too.
I can see that, yeah, dividend, huh?
They pay a dividend that yields 2.8%. Very solid in this environment. If you take a look over the last 12 years, they've increased that at a 5% average annual clip. You can see they're not like a consistent dividend increaser every year, but it's kind of a stair-step pattern. But you can see recently they've been increasing their dividend, and they said look out for another 8 to 12% dividend increase this year. So great income story as well. You're getting all this at a reasonable price. They trade about 22 times forward earnings, but historically they've traded at 22 times. So they've always kind of had a premium valuation for the solid name you're getting here. So I'd say that premium's justified, and there's a lot more upside potential here, I think, over the next couple of years as people continue to move into apartments.
All right, another company on your radar, Conagra Foods, CAG, the ticker symbol. This company is doing well despite the fluctuation in food costs?
They are, yeah. They've managed to at least pass that along, and I'll get to why in a second, but people probably know them well for their consumer brands. The Banquet, Pam, Chef Boyardee, Orville Redenbacher's, Healthy Choice, Peter Pan, I could go on and on. You'll find them everywhere in the grocery store and in our pantries. But they also have a solid business-to-business segment that they sell frozen potatoes, sweet potatoes, vegetable spices to well-known restaurants.
Right.
And also hotels, yeah, but any kind of industrial customers, and that they've been able to increase or pass through those cost increases to those operators. So not only are they seeing solid top line growth, they're seeing their operating margins expand too, and that was on display last quarter. They reported results for their second quarter of their fiscal 2013 on December 20th. Very solid beat. 16% growth in earnings per share, 9% growth in revenue. So it was their 5th consecutive positive earnings surprise, and you can see over the last couple of months, consensus estimates have been soaring for this company. It's a Zacks number 2 ranked buy, a very solid earnings momentum here, and based on consensus estimates, analysts expect low double-digit earnings per share growth over the next couple of years. So you've got growth here too, even though they're this huge company. They're delivering, like I said, solid top-line growth, but also that margin expansion. So very good growth, very good income as well. They pay a dividend that yields 3.2%. It's almost double what you'd get on a 10-year Treasury note right now. And you're getting all that at a reasonable price. They traded just 14 times forward earnings. That's in line with their historical median. So there's a lot to like here as well.
All right. Do you own either of these two?
I do not.
You can check out other stock pick ideas on our website, Zacks.com. If you're not there already, just go to the homepage. That's right where they're loaded up for your consideration. And we change them frequently, so check back frequently too. Zacks.com. With Todd, I'm Terry Ruffalo.